I recently became aware that Fidelity is offering a zero cost fund, mutual fund. And it's actually been out, I think, a couple years, but it's the first that I've heard of it. So I kind of like to talk about it a little bit today. So should you invest in Fidelity's free zero cost funds? Today I'm going to explain what I think about it. So here on their website, you can see there's actually 4 funds that they have. These are stock and bond index mutual funds, not ETFs, and sector ETFs have a lower expense than all comparable funds. Okay, so maybe there's a mix of them. So they're showing here that there's a zero minimum investment mutual fund. Fidelity, yes. Vanguard, no. Okay, that's true. But they're referring to mutual funds, not ETFs. And ETFs are vastly superior to mutual funds. It's like comparing a horse and buggy to a car. Zero expense ratio index mutual funds. Okay, Fidelity, yes. Vanguard, no. That's true. However, if you actually look into this, you can get ETFs free from either one of these through their brokerage accounts. And the brokerage account is free. There's no minimum. So if you want a free, no minimum investment, no commission trading ETF, you're going to get something that's vastly superior to a mutual fund. And you're not going to have to put up, much money at all. No minimum. And very, very low expense ratio on the funds. So the main one that they have here is the zero large cap index fund. This is supposed to be sort of like the S&P 500 fund, but they're not paying the S&P 500 people for that designation, so they can do it cheaper. But of course, it's probably going to be slightly different than the S&P 500, and it's probably going to underperform or lag behind the index. So it's not going to be as good. Now, if we click on this, you can see the rating is most of the Vanguard S&P 500 and the iShares S&P 500, which Fidelity owns. Most of these are rated 4 stars. And I think the reason for the 3-star rating is because it's a mutual fund and not an ETF. And I'll explain why. If you look at the expense ratio, the Vanguard S&P 500 fund, this is 0.03. The iShares, this is 0.03. And so that's a fraction of 1%. So you're not talking about a whole lot of money. And so what's the problem with mutual funds? Why do I hate mutual funds so much? It's not that I hate it. It's that when ETFs came out, it's clear you can find one source after another that'll tell you ETFs are way better. You want to get out of mutual funds, and most fund companies, a lot of them are migrating their clients out of mutual funds into ETFs. Vanguard's trying really hard because it's easier for the fund managers to manage, and it saves their clients money. Everybody wins with an ETF except for the IRS. The IRS gets less money. But there's also other things other than lower taxes. There's more transparency with ETFs, better trading, better pricing. So the thing about mutual funds is they have a thing called net asset value, and the price is determined. The last that I heard, it's end of day. So you can buy and sell mutual funds. You can put in an order, and I think the order doesn't go through immediately. It's like end of day. And let's say the stock market tanks 5%, and you put in an order to buy the Fidelity 500 index mutual fund, not the ETF. Then it's going to place that order at the previous. So the next day, let's say the order goes through the next day, it's gonna buy the shares at that price that it closed on, that the net asset value was calculated. An ETF is traded round the clock. So that price that you see, the ticker symbol, is just like a stock. You can buy and sell it all day long. you're getting the price for probably a very close to what it's actually trading at. I mean, the underlying assets versus a mutual fund, you could be off quite a bit. So that it's superior in that way. The main thing that I don't like about mutual funds, I used to have mutual funds a long time ago. I'm old enough to actually remember as a kid seeing my dad's mutual funds and seeing the capital gains taxes. And the thing about a mutual fund, it's like this. Let's say you're getting married to a spouse. Perhaps you're not familiar with the background of your spouse that you're going to marry. You get married to the spouse, and then you find out that he or she has all sorts of debts that you're not aware of, like all sorts of gains or debts, and you start filing taxes together jointly, and you're like, why do I have all these gains here? Where's the money? And your spouse could say, oh, well, I had a bunch of gambling winnings. And we'll say, well, where's the money? Oh, I spent it all. So that's what it's like with the mutual fund. So you buy into a mutual fund, somebody else is buying, there's other investors in that mutual fund. They're buying and selling it. As the fund manager buys and sells it, they're accruing losses and gains, and then you have capital gains and losses on their actions, stuff that you're not even aware of. And it may not become aware until the end of the year. It's not like they send you a notification all this when it happens. So with a stock or an ETF, you buy it. Let's say you buy Microsoft at $10 a share. You sell it at $20 a share. You've got a $10 gain. But let's say you decide, I'm going to hold on to Microsoft forever. You buy Microsoft at 10. You never sell it. And they don't pay dividend. You're never going to have any taxes on that. The way it's currently set up, you're never going to pay taxes because there's no gains, there's no losses. That's the way an ETF is. You can buy an S&P 500 fund ETF like Vanguard S&P 500 fund, VOO. You can buy it and hold it forever and never have to pay taxes on that except for the dividends that they pay out. That's the way a mutual fund should be, but it's not because it's an older way that it's set up. So that's why I would never buy a mutual fund. Once the ETFs came out, everybody will tell you ETFs are vastly superior. You don't want to be in mutual funds. And if you look at tax efficiency, the amount of gains that you get over the year, the ETF is superior. You're going to have, over a lifetime, you're probably going to get 5, 10, who knows, maybe $50,000 more if you hold it a long time. So you can see right here, even Fidelity is mentioning the positives of ETFs, intraday liquidity. So you can buy and sell it. You don't have to wait for them to calculate the value at the end of the day. Lower cost. Usually the costs are lower. So on most of them, except for more recently with this new Fidelity thing. Transparency. Like I said, if you're marrying a spouse and you're doing it blindly, you don't know their financial history, that's basically sort of like what a mutual fund is. You're getting into it blindly. You don't know what sort of debts or gains they have. And then you're going to get a capital gains. You may have capital gains that you're paying on your mutual fund. You've never bought, or so you bought the mutual fund, you never sold it, and then you've got a capital gains tax you have to pay at the end of the year. Who wants to have that? I know I don't. I want to buy something. I don't want to pay taxes on it until I sell it, or unless it's a dividend payout. That's the way ETFs work. So you can see here tax efficiency. They're mentioning that. Greater efficiency, greater flexibility. There's also a thing here they don't mention, portability. I saw some other YouTubers mention that. When you buy into this Fidelity, when you buy into the Fidelity zero cost funds, you're basically locked into their ecosystem. So if for some reason the Fidelity, you're not happy with them in the future, maybe the portal changes, maybe the management, you're not happy with them, the customer service, and you want to, let's say your money's grown. This stuff, even though it's inferior to the ETF, the money will still grow. So if you've had it 10 or 20 years and the money's grown, and then you decide, you know what, I'm really fed up with Fidelity, I want to move my money out, you're stuck. You can't transfer it out. So whatever, if they change the fees or whatever, you're stuck with them. So with an ETF, you can transfer it from one broker to another. If you're not happy with the broker, you can transfer it out. That's the great thing about an ETF. So those are the reasons why, even with the slightly lower expense ratio, I think when you consider the fact that you're going to probably pay taxes on someone else's gains, that's going to offset this 0% expense ratio. So you're probably going to do worse off with the Fidelity Zero index fund than you would with Vanguard VOO or the iShares S&P 500 fund, which Fidelity also owns. And you could actually buy these in Fidelity free of charge, no commission. You just have to pay it's automatically, the 0.03% fee is automatically taken out when you buy or sell. So you're never actually going to see the 0.03% fee. It's built into the ticker price, the price of the ETF. Just like QQQ, even though QQQ has a higher a higher fee, it's built into the price. I think that's one thing that for people new to investing that I should mention it. A lot of YouTubers don't mention that they'll look at the fee as like something that you subtract from your price of the ETF, but no, this is built in. So if you see a really, really pricey fund, ETF, you can, when you look at that stock chart of the ETF, it's automatically going to be, reducing that amount. So it makes it very easy. You don't have to worry about like having money in the account to pay your fees every year. So there's never an issue where you're delinquent your fees because it's automatically coming out of the you could have $0 in your account. These fees are going to get paid every year. It just comes out of the money in the ETF. So I would say if you're looking to go with the Fidelity zero cost ETF, zero cost, if you're looking to go with the Fidelity Zero Large Cap Index Fund, I would say don't fall for it. Free is often better, but not in this case. I would say go with the Vanguard S&P 500 fund, VOO. That would be my first choice. Or the second choice I would have would be the iShares Core S&P 500 fund ETF. It's also the same expense ratio. So those would be my two choices for the S&P 500 fund. Now, if you wanted to do the total stock market fund, Vanguard has a total stock market fund that you could also buy that's about the same as this, just about the same. I would say they're almost equal, called VTI. And then iShares also has one. I think it's called ITOT. So either one of those would be good. And that's something you can stick with for a long time and not have to worry about it. So that's my video for today. Hit that like button and subscribe. Thanks for watching. Feel free to comment in the videos.